There was definitely a lot more volatility in 2018, and particularly in Q4. And that caused markets to really retreat in Q4 in particular. As we head into 2019, we want to see if those risks are still going to be there in 2019. Now, there's no shortage of risks by any means, but I think the three key risks are interest rates, Brexit, and global trade. When we think about interest rates, we have to understand that interest rates impact both corporations and consumers. In the US, the Fed has raised rates 4 times, and the Bank of Canada has raised 3 times in Canada. So if you think about how does that play out, think of it this way. As rates go up, the cost of capital for corporations go up, which means they are going to have to pay more in order to drive growth, and that will impact margins. For the consumer, anything they tie in terms of their spending, if they're borrowing that borrowing cost has gone up. So that will also curb how much you spend going forward. In Canada, though, we have a further impact because of housing. So if rates go up, mortgage rates tend to go up with that. And we already have what I would call a vulnerable housing market. And so any risk to that would cause more negative consequences to Canada's economy. There's a lot to worry about Brexit, but let's start off with the fact that when you think about the Brexit resolution so far, we haven't had it. And that highlights the fact that there's a lot of difficulty in terms of the negotiations that's going on here. The second thing that I worry about is, UK politics. If you think about what's going on with Theresa May right now, she just went through a confidence vote. Now, she did pass that confidence vote, but even members of her cabinet didn't vote for her. So again, there's a lot of uncertainty going on from a political standpoint. Now, she has bought a bit of time to go back and renegotiate this deal, but there's still uncertainty as to how that will play out. If we end up getting a hard Brexit, that's definitely not good for the UK economy, but it also has negative consequences for the Eurozone as well, because they are 2 big trading partners. Now, this is not our base case scenario, but the probability of that is increasing. In our base case scenario, which is more of a softer Brexit, what I think will happen in that scenario is that we will see a slowdown in both economies, but again, one that is somewhat priced into the markets. Let's look at UK companies right now. When they're seeing this uncertainty that's going on, they're definitely pulling back on their spending, and they're looking for other countries to do business with. So again, pulling back on some of that revenue that would have been tied to the UK economy, which will have negative consequences going forward. Probably the biggest uncertainty out there, and the one that most people have followed, is global trade. And in particular, the trade discussions going on between US and China. And this has been, again, quite lengthy. And we just had a recent discussion between the two parties, which was actually not so bad. In that discussion, the US agreed to defer the tariffs going forward from January 1st to March 31st. And at the same time, China pulled back on some of their tariffs as well. So in the short term, this was definitely a positive. But it's definitely put a clock on that time frame as well to March 31st. And so that will add a little bit more volatility across the board. The impact of trade is important to understand, because if both of these countries, which are 2 of the largest in the world, get into a trade war, what we will see is rising prices, which will impact consumers because they have to pay more for those goods. But it also means that corporations, their input costs will go up, and they can't pass all of that to the consumer, so their margins will come down as well, and that'll have negative consequences to the stock market. So as we look through all of these risks, these are things that we'll monitor carefully and see how those will impact 2019.